Secured transactions is a worst-case scenario kind of topic. Of course, farmers don't borrow money if they think they can't repay it, but agriculture is a land and equipment-rich and cash-poor business most of the time, and shit happens. What kind of shit? Weather? Disease that affects your crops, your animals, or your family members? And that can all lead to bankruptcy. We are not covering bankruptcy laws here, but it's an issue for farmers. Lenders know it and they want security. They want a legal way to get their loan repaid, even if your cash runs out. To ensure that loans get paid, creditors create a security interest in the debtor's property when they make a loan. The debtor's property becomes collateral for the loan. This is really an area where a creditor just has to know how to dot the I's and cross the T's in order to have a valid security interest. This area of law makes giving loans much more attractive to the lender. It creates security that the lender will be paid back. And this is important because a creditor can repossess the debtor's property without going to court if the debtor does not repay the loan. And the first creditor to gain a security interest in a piece of property gets paid back before other creditors with a security interest in the same property. This is an example of a legal principle. First in time, first in right. The person who gave a loan and created a security interest first gets the first right to repayment. The law that governs secured transactions is Article 9 of the Uniform Commercial Code. Specifically, it applies when you are using the value of personal property to secure a loan. And remember, personal property is defined as any movable thing that you own in your own name. Personal property is everything you own except land and things attached to the land, like a house. Now, farmers are often the debtor. A bank, landlord, or equipment dealer is often the creditor. The farmer can buy something on credit or can take out a loan to get cash to run the farm. Now, let's see how secured transactions work in a tough year. You produce vegetable seeds under a production contract for a company that resells the seeds. In preparation for planting your spring crop, you take out a $10,000 loan from the First National Bank to get cash to buy your inputs. The first legal instrument you will sign is a contract called a loan agreement or a promissory note. The bank gives you money now and you promise to repay the loan according to the terms of the agreement. The two most common types of loan agreements are an installment note. This is a typical loan with an interest rate and a payment plan set out in advance, a certain amount of money per month, which includes principal and interest. The other kind is an open-ended note or a line of credit. The bank or a seller pre-approves you for a certain dollar amount that you can take out as you need it. The interest rate and repayment terms are decided up front. Now, most of us only think about the interest and payment schedule, but loan agreements have many terms, and you should understand them all. Default defines when you have breached the loan agreement. The definition of default is spelled out in the loan, such as how many payments are missed or how late you are in making a payment. The next term is acceleration. If you default on your loan, the contract usually says that the whole debt will be due immediately, not just the payment that you missed. The creditor can only accelerate the debt if there is an acceleration clause, and must do so in good faith, which means that they honestly believe that the debt won't be repaid. Loan agreements also contain terms for fees and expenses. A creditor can charge you for any legal fees or costs that are necessary to collect the loan if you default. They will also usually require co-signers and guarantors. A creditor will want someone with a good credit history to also be responsible for the loan. If you default, the creditor can go after a co-signer for the full amount of the loan. And inspections. If you secure a loan with collateral, the creditor usually gets the right to inspect the property to make sure that the debtor isn't misusing it, decreasing its value, and that it is still worth enough to cover the debt. Now, when the bank gives you a loan, it knows that agriculture is a risky business. In order to make sure that you are able to repay the loan, the bank will ask for collateral, the property that you promised to sell to pay off the loan if you are not able to keep making loan payments. This is called attachment. You will be asked to sign a security agreement identifying the property that you will use as collateral. You are attaching the property to the loan. Said another way, if you take out a loan and don't repay it, the lender can take your stuff or sell your stuff and take the money to repay the debt. But this process isn't automatic. The lender must create a security interest through the steps described later and identify which stuff can be used to repay the debt. Lenders can name specific items to use as collateral, such as your 1992 John Deere tractor. You might have to include the bank on the tractor's title if it is used to secure a loan or a line of credit. But lenders also use contracts that have general language for identifying collateral. For example, the security agreement might say that all accounts are used as collateral. What does that mean? If you are sitting at the bank, might you think twice about that language? It's a good idea to limit the bank to all business accounts. But remember, that also means that it's a good idea to keep your business funds separate from your personal funds. You should keep enough in your business accounts to run your business and pay yourself a fair wage into your personal accounts. Or you can cross out all accounts altogether and put a specific bank account number that you plan to use to pay your loan. You can also specify future payments on a contract, like that vegetable seed contract. You are taking out the loan to buy the inputs, so you will plan to use the contract payments to pay back the loan. The bank might also name the collateral by type, a broad category of property that you own. The types of property include farm products, such as crops, livestock, or farm supplies, inventory, which are goods that are held for sale or lease, consumer goods, which are things that you use for personal purposes, and equipment, which covers everything else you use to run your farm. Normally, creditors want a security interest in property that you already own, but farming is a productive business. So when a security agreement identifies the property, it can also include all presently owned property, things that you own right now, but it can also name after acquired property, which are things that you will own in the future, such as the crops that you plan to grow or livestock that you will purchase. Notice that you are taking out a loan to get money to buy things, so the lender wants to be able to get its hands on that valuable property if you don't pay the loan back. Now, let's look at the security agreement that the bank is proposing. It wants all accounts, but you've made that business accounts. And it also wants all presently owned farm products, inventory, and equipment. Think about the value of that property. The bank will want to make sure that it's enough to cover the loan down the road if you default. But you don't want to tie up more than you have to in collateral. Now, to be enforceable, the security agreement must be in writing, identify the collateral, and you must sign it. That makes the bank a secured creditor. It's happy to loan you money because the value of your property can be used to pay back the loan if you don't pay it. Now you take your fat bank account and buy the things you need to plant your crop of vegetable seeds. You hire some labor and you pay yourself a fair wage. The first payments come due on your loan. You are smart to keep business and personal accounts separate. You decide that you need more cash because you want to increase your herd of livestock. So you get a $5,000 line of credit from Western State Bank and buy a few more head of cattle. You sign the loan agreement, and in the security agreement, you give presently owned and after acquired livestock as collateral. After you leave the bank this time, a bank employee starts filling out a new form, the financing statement, also called a UCC-1. It is very simple. Your name, the bank's name, and the collateral that you attach to your loan, and you do not have to sign it. When you sign the security agreement, you gave the bank permission to file the financing statement. The bank will pay a small fee and file this with the Secretary of State in your state. and the bank will become a perfected secured creditor. Why would they do this? They want to be the first in line to take your property if you default on your loan. When the bank files the financing statement with the Secretary of State, it becomes a public record, and it puts other creditors on notice that you already have debt and have used some of your property as collateral. You are moving along with your operation, taking care of the new livestock, and your vegetable crop is coming up. Water's a little short this year, so you have to irrigate more than you expected, and you are paying more for feed and labor than you expected too. You are making loan payments on both of your loans. You've got good credit, so you go back to Western State Bank for another $5,000 installment loan, and the loan officers remember that you have a line of credit secured by your livestock. So she gives you another $5,000 as an installment loan and a security agreement that names all presently owned and after acquired farm products, inventory, and equipment. That's all general language, and you tell her the value of those items, which is more than enough to cover the loan. You sign the loan agreement and security agreement and go on your way. The loan officer again files a financing statement with the Secretary of State. But remember that loan with First National Bank? It also took your presently owned farm products, inventory, and equipment as collateral. Is that a problem? Because the financing statement is a public record, Western State Bank should have known that you already gave that property as collateral on a loan. But the secretary at First National Bank forgot to file the financing statement. It is still on the bottom of her inbox. If she had filed it, the loan officer at Western would have known that you already gave that property as collateral. You are moving along with your operation, taking care of the new livestock and your vegetable crop. You continue to have to irrigate, and you are paying more for feed and labor. You are making loan payments on all three of your loans. Now your tractor breaks down. You go to your local equipment dealer, who also provides financing, and buy a new tractor for $12,000 on credit. The dealer takes the tractor as collateral and becomes a perfected creditor with a purchase money security interest in the tractor, because they gave you the financing to buy the tractor and nothing else. So if they perfect within 20 days, they are the first to get the tractor, even though you gave Western Bank a security interest in your after-acquired equipment. Now the money keeps flowing out as your vegetable seed crop matures. You are feeling the strain of the debt. Now you are paying on 4 loans. You look around and think that everything you own is tied up as collateral for your debt. But once this crop is delivered, you will pay it off and hopefully have a little left over. And what's this? One of your cows is giving birth. She must have been pregnant when you bought her. Finally, a bit of good news, and you have some after-acquired livestock. But if you need a little cash now, you can't just sell some of this property, even your new calf, because it's being used as collateral. Security agreements contain restrictions on selling collateral to ensure that the value of the collateral will remain available to pay off the loan. A debtor must get the creditor's permission before selling collateral, and the debtor has to give the creditor a list of potential buyers to ensure that they are getting fair market value. If you sell collateral, it's called conversion, and there could be civil and criminal penalties. So you hang on to that calf for now. You have to pay wages and other bills again. All of your loan payments are due. You need to pay yourself some fair wage to pay for your house and necessities, but you don't have enough cash to pay all of your loan payments. You miss one payment on all of your loans. Good thing it's time to harvest your vegetable seed crop, but the company who contracted for the seed doesn't pay you for the whole crop. What the heck? You were counting on that money coming in at the end of the growing season. That company wasn't able to sell as much vegetable seed because of a drought during planting time for the vegetable farmers, so demand is down. The whole industry also produced too much vegetable seed, so there's also too much supply, and the seed companies are sitting on a lot of seed that they can't sell, so they don't have the money to pay all of their farmers, including you. Without payment on your vegetable seed contract, you miss all of your loan payments and default on all of your loans. What happens next? Well, your creditors could wait. There is no requirement for a creditor to act when a default occurs. Or you or your creditors could start negotiating to modify your loan agreements. It is good to be proactive. Your bank might be willing to take a security interest in the seed contract payments rather than your other property, and may be willing to wait for the cash. Or your creditors have the legal right to accelerate the debt. The bank can require you to pay the full amount that is due on the loan, plus interest and fees associated with collecting on the debt. How much do you owe in this situation? We can figure out how much is owed on each loan if they accelerated the debt now. You owe $5,000 to First National, $1,000 to Western on your line of credit, $2,000 to Western on your installment loan, and $10,000 for the tractor, plus any interest and fees. If the creditors accelerate the debt and you don't pay, they can repossess the collateral that you used to secure the loans. Does that mean that the bank will walk off with your cattle and tie them up in the bank parking lot? Of course not. They will sell the property and take the proceeds. Repossession can be done in a few ways. First, you can voluntarily turn over some agreed-upon property, and the creditor may forgive any excess debt. You can negotiate on this point. Or the lender can seek court-ordered repossession. The court order giving the creditor the right to the collateral is called replevin. Then permission to take the property is called claim and delivery. Sometimes the sheriff will get involved to take the property in these cases. Or the lender can resort to self-help repossession. That lets the lender physically take the property because it is legally theirs, if it can be done without a breach of the peace. They can't trespass, make threats, break locks, or do other damage. In your case, you have 4 different loans with 3 different creditors, all with different security interests, some perfected and some not perfected. So what is the order of priority?